Hi, my name is Danny Brown and I'm the CEO of Myriad Real Estate Group, and today we're going to talk about the recession that just won't happen. If you watch any sort of economic news or just the news in general, we have been discussing for a very long time an upcoming recession. And it just seems like it will never happen. And traditionally, people view a recession as 2 consecutive quarters of negative GDP growth, meaning that the amount of money that the United States creates is negative for 2 quarters back to back, basically. So I view that as a very simplistic view of what a recession looks like, especially in an economy like ours that is very nuanced and has tons of different sectors. And so, for me, a recession, it can be sector specific and is generally a loss of employment, loss of income, and a loss of productivity. Certain sectors of our economy have been in a recession. Housing, for example, my industry with realtors, lenders, title companies, homeowners insurance people. We have been in a recession since relatively about June of 2022, so about 15 months, because unemployment is going down. There's a lot less transactions happening, so sales income is dropping and our overall productivity is going down. So the housing market absolutely has been in a recession for quite some time. This year, tech was also in a recession. These big tech companies were laying a ton of people off. Their stock prices were way down and they were hemorrhaging money. Well, they are no longer in a recession off the heels of AI. So that has brought all their income back up. They cut a ton of jobs and then made themselves profitable again. And so tech is no longer in a recession. So there's this fundamental thought that because our economy has gotten so big and so nuanced, there might be something called rolling recessions, where certain sectors will be in recessions at different times. And when one sector is performing poorly, maybe another sector is performing really well. So, whether or not that plays out, time will only tell. But it is an interesting thing to think about that different sectors of the economy can be in a recession at different times. Over the last year, the Federal Reserve has been increasing rates at a pace that we've never seen before, right? So they have increased rates extremely quickly over the last 12 months. And that the Fed has a dual mandate, and that is something that where they have to combat inflation and keep it in check and monitor the unemployment rate and try to keep us as close to fully employed as possible. So the unemployment rate has remained exceptionally low over this course of time. So the Fed has not been focused on the unemployment rate really at all. They've been primarily focused on just trying to tame inflation and get it back down, which is why they've increased rates as quickly as they have. And with every rate increase, nothing happened to the job market. In fact, unemployment went lower during this advanced rate hike cycle. So the Fed feels really hawkish or overly aggressive because they can be, because everybody is still working and unemployment hasn't gone up. Now, if unemployment suddenly took a turn and started to go up pretty quickly, I think you would see the language from the Fed change because of their dual mandate. We are also closer to the end of this rate hiking cycle than the beginning. They are talking about doing one more rate hike this year. I think that is already baked into everything. So if and when they do another rate hike, it's only going to be 25 basis points and it'll probably come in November. And then I think we're done. And then you will start to see, and I think we are seeing, all of these rate hikes start to catch up with us. There is no way that you can be as aggressive as they have over such a short period of time and for things to not break in the economy. And so I think we're slowly starting to see some of those cracks play out, and it's starting to happen, and we're seeing them in the monthly numbers that get reported. My prediction, I don't really have one. A lot of experts are now saying that we are going to enter a recession next year in 2024. That may or may not happen. These same experts were saying that we were going to enter a recession in 2023, and then the Fed was actually going to cut rates because of that. Pay attention to the unemployment rate. When the unemployment rate starts to go up consistently, then and only then do I think that we will be actually in some sort of recession. So right now the unemployment rate, I believe, is hovering around 3.9%. That is at full unemployment. Full unemployment's up until I think 4.5%. So the Fed has a lot of room to play with right now. And so we are very far away. It's hard for the United States to fully be in a recession when unemployment is so low. So when everybody's working, everybody's making money, you just cannot be in a recession regardless of what GDP is doing. So really pay attention. That leading indicator and that telltale sign is going to be the rate of unemployment. And that fortunately comes out, we get that every month to see what the previous month's unemployment rate was. Remember, when a recession happens, that a majority of the country is still working. So even if the unemployment rate went up to 5%, 95% of the country is still working. So a recession isn't necessarily the end of the world. Again, my industry has been in a recession for about 15 months, and we change our budgets and we scale back a little bit and we pivot what we're doing, with the understanding that there's going to be less transactions, less income coming in, and you just kind of evolve your practice. And the general thing to remember, the saying that I love the most when it comes to a recession, is it's just a recession when your neighbor loses their job. It's a crisis when you lose yours. So again, most people are going to end up working during a recession, and it's not the end of the world when we do hit one. And I also don't think that I don't necessarily subscribe to the idea that this upcoming recession is going to be what's called a soft landing, where it's super mild, everything's hunky-dory, and we just kind of keep going forward. But I also don't think that it's going to be extreme. I don't think it's going to be similar to the financial crisis of 2008 or a Great Depression situation. I think we will have a run-of-the-mill recession. And again, it all comes from, you cannot increase rates as aggressively as the Fed has over a year and not expect things to break. It will happen. It just takes a little time for all of this stuff to catch up because they did it in such a short period of time. The only thing I would say is to prepare for a recession is to make sure that you have savings, right? You don't want to rely on credit card debt. In a high rate environment like we're in, credit card interest rates are through the roof. I think they're north of 25%. I know some people are paying north of 30% on credit cards. So make sure you have savings. And if your sector is not in a recession yet, put that away and just plan. The nice thing about a high rate environment is your liquid savings accounts are paying around 5% right now. So you are getting a nice return on those high yield savings. So, general rule of thumb in a normal environment is to have 3 to 6 months cash reserves. If we're headed into a recessionary environment, which they keep saying we are, right? Like, that's the point of this whole video. It might make sense to have 6 to 12 months cash reserves set aside just in case. And again, earning 5% on that cash and having total liquidity is a really good thing. And then if you don't need it, you've got all this money saved up that you can invest it into something in the future, or buy yourself something really cool, go on vacation, whatever it is. So I would be planning on just having cash reserves set aside in a high yield savings account, earning 5%, and just be prepared for this recession that just hasn't materialized yet. If you have any questions or comments, leave them below, and don't forget to give a like and subscribe, and we will see you next time.